Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation.
So you made it back. You're ready for the second part of this amazing conversation with one of my mentors, Russell Gray, the financial strategist and co-host of the Real Estate Guys. We've told you about what you're going to hear. So let's just get right into the second part of the conversation and make sure that you're taking notes, because Russell really leaves lots of value on the table so that you can get the most out of it. All right, let's get right into the conversation.
And Russ, when you're talking about migration patterns, right, and you're talking about looking at those things, what are some of the ways that someone who is looking to actively or passively invest, they can find out, like, how are people moving from one place to the other in the U.S.? It may be something that they're interested in now because they're listening to this conversation and they just don't know where to start to look for those types of migration patterns.
Well, a lot of times it gets reported in the news. Wallet Hub does surveys from time to time, and U-Haul and United Van Lines and different companies, at least in the U.S., publish where people are moving to and where people are moving from. Visual Capitalist and Statista put out these graphics that show that. I tend to like to plug into chambers of commerce, so I watch the mainstream news to look for clues, and then I dig into the local marketplace and try to form a relationship with what I call our boots on the ground correspondents, people that, because of the branding and the positioning that I'm in, will take my phone call and will talk to me. So I'm unique, but we share that on our YouTube channel. We share all those interviews with people, and I cover a lot of different markets. You look at migration patterns that have been happening, a long time. I spend most of my time paying attention to the United States. I know your audience. My audience also is international, but the bulk of our audience is in the U.S. But the pattern, the principles are the same. People have been moving at retirement from New York and Boston to Florida, and that's been going on forever. In the 10 years, about 50,000 people a year move from New York to Florida every year. So in 10 years, the entire population of the state of Wyoming moves into Florida, right? That was going on before, but now people don't have to wait to retire. So Central Florida is exploding because no state income tax, affordable living, great weather. So you just look for those kind of trends. But the Chamber of Commerce is out there marketing their communities to other places. In fact, I was watching TV, I don't know, the other day, and I think it was Spain. I thought of you. Spain, I think, was marketing themselves. But, look at whatever the ministries is, like in Belize, it's the Ministry of Tourism, and you have chambers of commerce or whatever. But whoever is marketing that country to CEOs and business leaders to try to get businesses to locate there, what are they saying? What is their story? Is it a compelling story? Are businesses making those moves? Because for the most part, businesses are going to put in the homework first, and they're going to go create the jobs, and the people will come. People will move for the job, unless you're dealing specifically with places that people go to retire, and then that's a different game, right? So you have to, I talked earlier at the top of the interview about the importance of paying attention to the demographics, right? You can make a lot of money right now catering to baby boomers and their healthcare needs, which is the season of life they're in, and their retirement proclivities, or millennials. Very different demographic, right? But if you create products and markets and things that cater to millennials, then you could probably do well too, because they're going to be a force. So just understand your demographic, and then understand the appeal, the comparative appeal of one market to another market, so that people and businesses that are shopping, so you can see it through the way they see it. And then you look and see what's really happening, what people are really doing, voting with their checkbook, and then you pivot off that. Because usually these patterns, once they start to emerge, I mean, it's not like, everybody moves in one day and it's over. The trend will start to emerge, and it goes on for a long, long time. That's a long wave you can ride, especially as a real estate investor.
Perfect. So looking for these trends, you've talked about some of the different areas. So you can look at the Chamber of Commerce as well and find out what story they're telling, how they're marketing. And you talked about the boots on the ground. So, right, a lot of busy professionals that don't have time, but at the same time want to protect their wealth, looking for real assets. How do you go about figuring out what is the right team we talked about how we get to the market and watching the patterns, but what is the right, maybe some tips you could help us to understand on, or tips, or help to educate us more on some of the things we should be looking for when we're looking for the right team in the right market?
Yeah, well, the way Robert and I approach it is we start out with personal investment philosophy. You have to think about who you are, what you want, what you're willing to do, what you're not willing to do, what you have to work with. And your philosophy, it kind of becomes a strategy, time frames, whether you're trying to create equity, cash flow, tax breaks, lifestyle. I mean, there's a lot of things. When you kind of figure that out, and that takes a little bit of work, the next thing you do is you look for markets, and markets are product niches, geographic markets, and demographics that you think are most compatible with, or most likely to create the kind of results that are going to be compatible with what your goals are in your investment strategy. From there, you begin to look for thought leaders. You begin to look for people who are active practitioners. You try to break into that community. If you go to a brand new school, I'm trying to think of something that we all have in common, but you go to a brand new school, or you go to a brand new company, and you're the new guy or gal on the scene, you're kind of sit back and you observe a little bit, and you based on who you think you are and where you think you fit, you try to find somebody that is open to having a relationship with you, that is connected to a whole community of people that you want to be connected to. And if you build if you just focus on developing that one great relationship, then that one great relationship introduces you to everybody else at the party, everybody else in the company, everybody else on the campus, right? And then little by little, your network expands. So it's the same principle, so, you may listen to, and people who are out there who are service providers put themselves out there. I mean, every guy and gal that I interview on Boots on the Ground, they're service providers in their different marketplaces. Now, I'm positioning them as subject matter experts because they are, and I'm not letting them pitch. I'm just getting them to explain what they know. And if somebody watches that and says, yes, I'd like to engage with them, then they can. And now they've got that one relationship. That one relationship can introduce them to the lender, to the title company, to the property manager, to the, to everybody else that they need to know. And pretty soon you're kind of in the community. How you behave once you're in the community dictates how much of how well you're accepted and how much support you get from the community. But again, just use the basic social skills you developed in school and corporate life. And if you weren't very good at those social skills, then study them and get good at them, because at the end of the day, this is a relationship business. And I think the biggest decision people need to make is, are they going to be active managers in their own account? Or if they're busy professionals and they want to put their creative energy and focus on what they do and making money, and they love it, then I think that you probably are going to want to be a passive investor investing through what we call syndicators. And these are people who aggregate capital from high net worth or affluent people that have excess savings they want to put to work, but don't want to get their hands dirty. It's not Wall Street. It's not a casino. And if you pick the right people and the right assets, and again, you have to listen to their investment philosophy and vet them. But once you get a good relationship with a few of those folks, even one, then they keep your capital working. Robert Kiyosaki made a lot of money, made most of his money writing books. He became financially independent investing in real estate, but he became a multi-millionaire writing books. And when he got all that money, he knew that he did not want to go be a hands-on real estate investor. And so he found Ken McElroy, who's a syndicator, and gives Kenny money, and then Kenny goes and invests in apartments and manages the money, and they're partners, right? Kenny does the work, gets a piece of the action. Robert puts up the money, gets most of the action, and it's a win-win situation. That's what you're looking for if you're a busy professional and you don't want to be distracted. The flip side of that is if you're a busy professional, but you're insecure in your job and you're like, oh my gosh, I'm not sure that this great 6-figure income I've been enjoying is going to be here in 5 years. And you need to start a business where you have a chance to make that kind of income and you want to be active investing. Well, then that's when you want to become a syndicator. You want to learn that skill because now you combine your earning of money with your investing of money into one activity. And you put all your energy into that and you really can compress timeframes. I'm not saying everybody should do it, but I think a lot of people don't even know that it's a possibility. And of course, Billy, as you know, we spend a lot of time at the Real Estate Guys trying to open people's mind up to playing the game that way because we think it's the best opportunity in business and the best opportunity in real estate investing.
And I absolutely agree with you that it is the best opportunity. And just a couple of things I want to talk about because you talked about really what I've heard you say is it's really about being, number one, strategic in the way that you look for your partners. And then also just don't do anything weird, right? Just be just like normal social behavior. Once you have met someone, take the time to get to know them more, whether that's using technology, being able to get on a plane once we can start to do that again and meet them, understand what they're doing. And you and Robert do a great job, whether it's via your website or your YouTube channel or all the different ways that you're actually adding value to people. You also make it really easy. And I know one of the things is success leaves clues, and you've been able to do that for quite a while. And so it's about also seeing who is able to do this and being able to follow people like yourself and Robert. So I appreciate you sharing that. There is this thing also too that I know, especially for people when you're starting in real estate or you're starting in investing in real assets in general. And there's this whole concept that people think about, well, I want to make as much cash flow or revenue and profit as possible. I want to get as much revenue and profit as possible. Now, there's a whole thing that a lot of people don't talk about. And I would love for you to kind of juxtapose those two concepts with this concept, which is liquidity. And which is really, where should we really be focusing our energy if we want to be focused on protecting and growing our wealth?
So it's a great question. And, one of my great experiences in life as the co-host of the Real Estate Guys radio show is in 2015, January 24th, I believe it was. I remember the date very well. And I was in Iowa and it was freezing cold, but I was in the press room at a conference where Donald Trump, before he was presidential candidate, he was just real estate mogul Donald Trump, was the keynote speaker. And Robert, my partner, who usually does the interviews, especially interviews of that magnitude, had to catch a plane to go to Belize. And so there I am in the press room representing the Real Estate Guys with other people in local press. I mean, you don't get a lot of one-on-one time with Trump, but I did get a chance to ask him a question. And I said, Mr. Trump, you've seen good times. Art of the Deal and your big ascent to national prominence. And you've seen bad times, where you've been completely like nearly a $1 billion negative net worth and creditors after you and bankruptcies. So what did you learn in the good times and what did you learn in the bad times? And how would those experiences help you if you did decide to run for president? Well, he didn't answer the last part of the question. He didn't want to play his hand. But he goes, yeah, I really didn't learn anything in the good times, but I learned in the bad times, it's always good to have a little cash. And so I had another business mentor later in life who told me that cash is like oxygen and a profit is like water. And or food, I think, and then revenue is like water, and so the idea is that you can live for a while without profit, without food. You can go quite a while. You can live off your balance sheet. You can survive. You can survive for a little bit without revenue, but you don't live very long without oxygen. You don't live very long without cash. So it's always important to have cash. And I made the mistake in 2008 of thinking that easy access to big credit lines was liquidity. And then when those credit lines were shut off without any warning and without any justification, I thought I was safe because, they advertise, hey, we help small businesses get over their cash flow humps. American Express, they suck. I'm sorry. But, marketing is disconnected from, the reality of the risk management. And they saw a train wreck coming. Of course, I didn't see it, but they saw it coming and they were starting to batten down the hatches. And I was victimized by that. So I had a lot of working capital. So, being liquid is important. Having cash on hand to put out fires, to deal with unexpected things, even if you're just consumer finance, the quintessential emergency fund, if you get unemployed or have an emergency expense, right? It's important to have some cash on hand. The bigger your burn, the longer your path. I tell every entrepreneur, you always have to know your shortest path to cash. You have to know what do I have that I can go sell? How quickly can I sell it? And how quickly can I get money in the bank? How much cash reserves I have is largely dictated by that. If I have a short path to cash, I can run a little thinner. If I have a long path to cash, if I have to invent a product and do R&D and get it approved, and it's a 5-year cycle, I have to have a heck of a lot more cash. The mistake I think a lot of people make is they invest in assets for long term that are also highly liquid. And the problem with that is that anything highly liquid is highly volatile.
So can you? Sorry to cut you off, Russ, but can you give us an example when you say highly liquid, just so we understand exactly what you mean?
Well, highly liquid means it can be converted to cash quickly. I can place a sell order and get cash in my account right away. Right? Stocks. Yep. People say I'm a buy and hold stock investor. What kind of stock are you buying? Publicly traded. You mean stuff that can be liquidated like this afternoon on a heartbeat? Yeah. Well, that's a pretty wild ride. Now, if I am a stock investor and I buy stock in privately owned companies, small businesses, those are not highly liquid. I don't just go sell my shares in a small business willy-nilly. But it's also a lot more stable. And so what I'm saying is a lot of people in their quest for liquidity mix liquidity with long-term investing. And I think the best long-term investments, things like real estate, they're not as liquid. They're just not. So you have a portion of your portfolio that's dedicated to liquidity, and you have a portion of your portfolio that's dedicated to cash flow and a hedge against inflation and long-term growth, long-term equity growth. And when you can introduce debt to leverage the slow, growth of equity, now you can get internal rates of return that are pretty attractive and fairly stable. And so your balance sheet stays a little bit more stable. So that kind of gets more into advanced like portfolio theory, real asset portfolio theory. I spent a bunch of time after 2008 going through how would I construct a portfolio to withstand a 2008. I did a webinar on that, and it's still floating around out there somewhere. But I want to update it because, and I think it's in the Syndication Mentoring Club platform. Billy, you have access to that. Yeah. And it was really an introduction to the concept. But most portfolio theory is based on asset allocation, but it really doesn't deal with counterparty risk. It doesn't deal with some of the other things, liquidity, because it's assumed that everything in your portfolio is liquid, and that's not necessarily true. And it doesn't really take into account nuances of risk. So, center mass is stuff that's super liquid, super safe, stable. And then you got stuff that's further out in what I call the rings of risk. And you have to have firewalls so that stuff you're doing out here on the edge can't take down your entire balance sheet, right? Personal guarantees on spec deals, that would be dumb, right? Things like that. If you're going to take those chances, and then through asset protection and estate planning tools, you create structures so that you can go ahead and take those risks and you don't threaten the rest of your portfolio. So when you start to play the game at that level, you have to really spend time on understanding your structure. And you can't just be running around, like me and maybe my LLC. It's a lot more complicated than that when you get to that level.
And when you're at that level, or you want to move to that level, this is one of the areas where you're really adding lots of value for people across the globe, and then also to the people that are part of your mentoring club, so that you can actually see exactly some of these concepts that you can even dive even deeper into. So I can attest to that. So listen, Russ, there's so many things. I mean, I could keep asking you questions forever and ever, and I know we're coming close to our time, but there is just one last thing before I ask you the final 3 questions, if you could, because you've kind of touched around it a little bit, and I want to go back to this whole thing about the markets in general and really paper assets. And a lot of times you talked about some of the liquidity and being able to get in and to get out and things like that, but there's this whole concept of just exposure to systemic risk. And I know that you do a really great, I mean, you've helped people understand just what that whole concept of systemic risk is, because lots of people that are in the casino or in the market don't really know about it. So if you could just kind of help us understand, what is that whole systemic risk concept about?
Yeah, well, so a couple things. First, let's just deal, because we've tossed it around but haven't defined it for people. We've talked about paper assets and real assets. What's the difference? A paper asset is where you have a claim on wealth. A real asset is where you have wealth directly. And so, when you own stock in a company, that's a paper asset because you don't really own anything except a claim on the revenue or a claim on the, it is an ongoing concern. And really what you're trading is what somebody else's bid would be to own that claim instead of you, right? Okay. Mm-hmm. A real asset is something like, I own a piece of property and I own it. I own an ounce of gold and I own it. I own a bag of diamonds and I own them. I mean, I have fine art and it's mine. I mean, so those are real assets, agriculture, oil, things like that, things that are tangible. And, some real assets aren't worth anything and you end up selling them at a garage sale, but some assets are worth a lot. And those are the things you want to accumulate. So there's that. As far as systemic risk goes, it comes in a couple different flavors. First flavor is asset price risk. If you have a balance sheet that is based on estimates of value, as we talked about earlier, and those values are largely predicated upon healthy credit markets enabling a bid. Okay, so if the reason my house is worth $500,000 is because somebody can get a $400,000 loan, if the lending world collapses, if the financial system collapses and lending goes away, the bid, the purchasing power to keep that price up goes away too. And that equity that I thought I could borrow against in a liquidity event need goes away too. Okay, so you're vulnerable when the financial system goes down. So if you don't understand how your asset values, the asset side of your balance sheet is affected by a healthy credit market, you could be facing systemic risk. If you have money in the bank in excess of $250,000 and you're not aware in the United States of the Dodd-Frank legislation, which in 2014 activated something they passed years before, that you are now an unsecured creditor to the bank, and they can take all or part of your savings over that $250,000 to handle their own insolvency issues. And so if you're not aware of that, then you're subject to counterparty risk, which is the other part of the risk, but the systemic risk. If the banking system fails, that the counterparty risk becomes activated. And then the other part of the risk is the counterparty risk itself. So for example, if I own stocks, and I own them in a stock brokerage account, and I don't have the physical share certificates in my possession. If I own bonds and I don't have the actual bonds in my possession, then what I own is a claim, an IOU, and my broker owns them for me, and he owes them to me. And if he goes broke, there's the potential that I don't get them. I don't really own them. And so there's these types of risks that are in the financial system that people are just unaware of. You might say, well, it's not that big of a deal. Okay, well, it may not be that big of a deal, but then when it is a big deal, that's when it becomes a big deal, right? It wasn't a big deal in 2008 until it was, right? And we don't know what's going to happen in 2020. Things that may not be that big of a deal could be a big deal. The dollar's not really at risk. Really, there's some pretty major people out there suggesting that Ray Dalio is one of them, big guy, Bridgewater, saying, hey, the dollar could be in trouble, right? There's China, the largest manufacturing economy in the world, and maybe arguably the largest economy in the world, is actively working and calling for a de-dollarization. I mean, Russia is too. So there's a lot of powerful forces. And then you've got what we talked about earlier with the Fed. So the currency is part of that systemic risk. The banking system, the bond and credit markets, and the currency are all part of systemic risk that most people do not know they're exposed to. And they certainly don't know how to evaluate that exposure or mitigate the exposure. And so this is not going to be an end-all, be-all interview. It's going to really open up people's minds, I hope, to the idea that, hey, I didn't even know what I didn't know, and I need to start paying attention, because it's better to pay attention before you need to know. You don't want to be saying, gee, I wonder where the fire extinguisher and the fire escape is after the house is burning down, right? You want to know where it is before, just in case. And I don't know what the odds of it burning down are. I don't know. But I can say that there's a lot of stuff going on right now that is crazy, and crazy things could happen. And so I think a prudent person needs to be prepared.
Completely agree. Definitely want them to be prepared. And I sure don't want to be one of the millions of people running for the door at the same time. That would not be
Right.
a good thing. So, and Russ, I know you also you're helping people. There is you have a Future of Money and Wealth that really helps people to understand what is happening, some of the different concepts that you're talking about. So one of the things we'll do is make sure that we also include that in the show notes today, because I think it's really important for people to be able to know more about that. So,
Okay.
So I'll speak to your team about making sure we add that in the notes. So, listen, Russ, I appreciate so many things, but it's time that we get to the going long final 3 questions. So I will ask you those questions only if you let me know that you're ready for me to ask you the questions. Are you ready?
Well, I haven't caught anything long in a long time, so I might bobble or fumble, but I'll do my best. I'm certainly not my nephew. My nephew's got great hands, me not so much.
So listen, we know this is going to be perfect. You're all good. So first question, we talked about kind of from outside of the U.S. into the U.S. where you were in the very beginning, but I'd also like to kind of move it the other way. So if you could help us understand, what is your favorite European city, either that you visited or you still have on your bucket list to visit?
Well, I've only ever been to Europe once, and it was a whirlwind trip. Robert and I flew out there to interview Ivana Trump. We were working on a real estate project with her in Las Vegas, and to promote it, we went out and flew to Las Vegas, she was at the hotel where they were filming the Da Vinci Code. And I'd never been. It was a 54-hour trip from San Francisco to France and back. That's as long as it was. So I didn't sleep at all, except for on the plane. And we visited the Eiffel Tower, which was super cool, looking out over properties that were 500 years old. And we think a property here in the U.S. is 80 years old. It's ancient. And we're looking at these things that were built 500 years ago. We're like, wow, that's a paradigm shift. And on top of each other, the density was amazing. Not high, but just dense. So I don't, I've only ever been to Paris. So that's, you think a guy, I've been around a lot in the Americas, but not so much in Paris. So as far as Europe goes. So right now, I can't say it's my favorite. It's the only one I've ever been to, but I had a good time. Although the French people, I don't think necessarily liked Americans so much. They didn't like me that much anyway. We'll see.
Well, listen, so I moved there and I have wonderful memories. In 2001, I was supposed to be a 1-year sabbatical, and it's been 19 years later, a marriage and 2 kids. So Paris started off things very well for me as well. And I moved there in 2001. So it was kind of a tense political time at that point in time.
Oh, okay. Well, you were there when I came and visited. I was out there in 2004, I think.
Okay. So. Yeah. So right around then. All right, cool. Yeah. Learn something new every day. The other thing is, so as a successful entrepreneur, business owner, educator, I'm going to guess that you've probably only made one mistake throughout this entire time, or maybe more. I don't know. But if you can think of one mistake or one learning opportunity that you had, and most importantly, what lesson that you learned from that you would pay forward to someone else.
Yeah, I would say that the biggest mistake that I've made, and I continually struggle not to make, but I always flirt with, is being too smart for my own good. In other words, sometimes I study an issue, or sometimes I get so wrapped up in my own way of thinking or my own perspective, I'm more interested in telling other people what I've learned than learning what they've learned. Talking too much, not listening enough, being the smartest guy in the room. We were working to be the smartest guys in the room and filling up rooms that we were monetizing. And then after 2008 and a mega double helping of humility, we realized that being the smartest guys in the room was not only stupid, but it was irresponsible. And so we set about concentrating on building rooms of people much smarter than us, trying to listen more than we talk, and using the platform of the Real Estate Guys radio show to get into those relationships and to create lots of great content and to share the things that we were learning and to become conduits much more than than thought leaders. Although along the way, you learn some things, and I have my moments in the sun where I have something I've studied and I have some things to say, and I'm happy to share them. I don't believe in false humility, but you really do have to know your limitations. Clint Eastwood said famously, "Man's got to know his limitations," and I've learned that in life. You have to know your limitations and be smart about the risks you take when you're pushing the envelope.
Okay, awesome. So be smart about the risks you take, and surround yourself with smart people. So, and lastly, so one of the things that we've talked about, and I know you are a best-selling author with Equity Happens, and we always like to kind of wrap things up, continuing to educate people. So, what book are you recommending right about now?
Well, I mean, there's so many. It depends on what you're trying to do. I think the foundational book that you have to read if you really want to make the shift from being that corporate employee and working for somebody else and getting a paycheck, nobody does it better than Robert Kiyosaki in Rich Dad, Poor Dad. I mean, that's the paradigm shifting book. Now, I can't say that was the book that changed my life. I was already there by the time I read it, but everything he writes in it is just right on the mark. And the evidence is how many lives have been changed and how many millions of people it's influenced. I could run off a quick laundry list of a whole bunch of other books for business and investing and blah, 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 economics. But I think that, really to start the shift from being a worker bee, a drone, to taking charge of your own future and destiny and opening your mind up to your potential, it's Rich Dad, Poor Dad.
Rich Dad, Poor Dad. Fantastic. And you also just made me think about, I know one of the things you really like to talk about is think about units. So number of lives impacted versus dollars. And so that's one of the concepts that really drives it home as well. So Rich Dad, Poor Dad. Russ, you've helped share things from the very beginning as a father, as a son of an immigrant, and being able to be really focused to moving from money, moving to mission, really focusing on strategy, also really having this passion about going out to help others to become the best versions of themselves. We talked about syndication. We talked about the economy. We talked about a lot of things. And I'm sure that so many people that are listening to this episode and are watching us on the video version of the episode are thinking to themselves, how in the world do I get more of Russ? How do I find out more about him, what he's doing, how he's helping to impact lives, and things like that? So could you just help us understand what is the best way for us to know more about you and your universe?
Well, I think if you just send an email to newsletter@realestateguysradio.com, you'll get on our newsletter, and then we talk to our list. And every week, I personally write a commentary, and then we, talk about the different events and appearances that we're either involved in, producing, or promoting. We send out podcast announcements when we release a new podcast. You'll learn about our YouTube channel where we're producing new tutorial series on different topics. So it's really being on our email list is the key to unlocking everything that we have. And if you don't like the stuff we send you, you can always unsubscribe. But hopefully, if you like the interview and you listen this far, you'll like it. Newsletter@realestateguysradio.com.
Newsletter at realestateguysradio.com is the place to go to find out more about Russ and what he's doing over at the Real Estate Guys. And I can tell you that you have personally impacted me positively and have helped me to continue to take my game to the next level, stretch, take me outside of my comfort zone, and also been there as a wonderful mentor. So I really appreciate you taking the time today to share your story, your insights with me and the entire Going Long audience. So thanks so much, Russ.
It's been my pleasure, Billy. Thank you, and congratulations on the show.
All right. Thank you very much. And for all of the Going Long audience, really want to once again say thank you. And because of the richness of the episode today, I know you're going to want to go out there and share this episode with at least 2 or 3 other people to help positively impact their lives and help them understand more about what Russ and the Real Estate Guys are doing. We'd love to get your review, know what you loved about today's conversation. And listen, if you want to leave us a 5-star review, we'll be happy to take that as well. But most importantly, go ahead and let us know what you loved about today's episode. And until then, I'm really looking forward to welcoming you back to the very next conversation. So go out and make it a great day.
Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.